This concept I'm going to call the hunt, or that's sort of what I'm going to coin this term. And what I mean by this has been sort of described by quite a few famous and successful investors already, and in some ways sort of I've formed it into this idea. And for me personally, that means focusing on the best 1 to 3 opportunities per year, and off 1 to 2 perhaps even, where every year, every time I look at an investment, I think to myself, is this the best 1 to 2 opportunities I will see this year? And that's sort of the filter I run it by. So if I'm expecting a double up, that might be okay, but do I think that's really the best or second best opportunity there is that year? Now, it's not necessarily about how high is the upside, it's about the risk to reward and the probability. And is there any sort of downside protection? So it could be a double up and it could be the best opportunity there is that year, just in terms of a risk to reward. It might be, very low risk. There might be a lot of margin of safety there and reasons for that. And I know quite a few famous investors have mentioned this. So Stanley Druckenmiller has sort of mentioned the opportunity of a fat pitch. He always, he looks for those, what he calls a fat pitch. What are those really high quality opportunities that he can take advantage of? I know he takes very few positions as well. Warren Buffett and Charlie Munger often mentioned about being concentrated, which again is of similar thought, where you should hold a few positions. Diversification is a protection against essentially being a fool or lack of understanding. So if you're looking for those best opportunities, you really shouldn't be that diversified. I know it's often mentioned that your top 50 ideas aren't going to compare to your top 3 as a whole. They're not all going to be of the same quality. Monish Pabrai also says that he looks for an opportunity with about a 5x potential return, perhaps a 10x, even a 100x if possible. The higher, obviously, the better. But what he means by that is if he sees something where it's a 50-cent dollar trading at a dollar bill, he's not interested. And there's a reason for that. It's because he only wants the highest quality opportunities. I think that's made the point somewhat clear as to what I'm aiming for. But essentially, every time I look at a business, I'm looking, is this the best 1 to 2 opportunities for that year? And if I can't say with confidence that it is, it's not something I'll likely continue to pursue. I think it's a good sort of mental framework to have surrounding this, because there are quite a lot of decent opportunities I could see out there, but then what ends up happening is I might end up having 15-20 positions, and then it's tracking all those positions. So this is the downside of doing that, is you might be more diversified, but then you have to track all those positions, which is very time consuming, and ultimately a lot of people will end up just not tracking it very well unless it's your full-time professional job. You just won't end up tracking the quarterly calls, the investor updates, what's going on with the business. Is it still performing well? Is it still meeting your expectations? Because a lot of the time it won't work out. So it'll increase your room for error there. Whereas if you're tracking, 6 businesses, you'll know them very well, and you'll know actually this business isn't performing as well as I thought, and as well as I rationalised, and then you can make a more informed, intelligent decision from there. The quality of your overall picks go down the more you sort of have these positions, and quite often I've found that my returns have actually come from a few top performing positions, which don't necessarily mean that I anticipate for them to have the highest return, but it just means that they were often the best risk to reward profiles, and I think the market ended up appreciating those aspects over time. So I think if you can sort of just cherry pick those and select them out, you'll be doing much better. Of course, there is risk in being concentrated as well, but as long as you have downside protection there, you can actually have. I would argue there could be a safer portfolio if it's a fewer positions, but each position has some sort of downside risk protections. For example, one business might have guaranteed contracts for half of their revenue at a very profitable rate for the next 4 years, which I've seen. One could be trading at a ridiculously low price to earnings ratio. Another could have its entire assets, its net assets, meaning the assets minus liabilities, far greater than its market cap, or roughly its market cap, when you exclude items such as goodwill, software, and perhaps long-term investments in certain things which might not be as clear. That can give you a lot of downside protection, and that's sort of what I mean about picking the best 1 to 2 opportunities per year. I think that's given me a lot of guidance around my investment decisions and preventing me as well from overloading with positions. I'd rather take no positions that year than take 10 mediocre positions that year, if that makes sense. Of course, you do want to have stuff that you're holding, but I'm assuming you've got like 1 or 2 long-term compounders there already. You might have like Amazon, which is a great business. You might have bought a decent valuation, and that's something you might just want to hold because you know it's going to be returning 20-30% return on invested capital over time. I don't know if that's actually how much you're returning, but if you have such type of businesses, they're worth holding on to.